Assalamualaikum and a very good morning. Okay, as for today, my group will be presenting about the ISA 240, which is the auditor's responsibilities relating to fraud in an audit financial statement. My name is Muhammad Azad Rahimi and here's my group mate Muhammad Zakwan, Nordiana Nasuha, Nurin Sharina and Nurul Amirah. Let's our knowledge sharing begins.
Okay, Assalamualaikum to Prof and friends. Okay, we are from Group 2 would like to present on the auditor's responsibilities relating to fraud in and audit financial statement. Okay, allow me to introduce myself. I'm Muhammad Zakwan. We'll be start with the introduction. Okay, first of all, this is international standard on auditing, which we call ISE, deals with the auditor's responsibilities relating to fraud in an audit of financial statement. Specifically, it expands on how ISE 3151 and ISE 3302 are to be applied in relation to risk of material misstatement due to fraud. Okay, next we will continue with the characteristic of fraud. Okay, how to recognize the first picture you found in the image. Misstatement in financial statement in which arise from fraud or error. Either the misstatement of financial statements is intentional or unintentional. Okay. There are two types of intentional misstatement. First, misstatements resulting from fraudulent financial reporting. Second, misstatements resulting from misappropriation of assets. Okay, although the auditor may suspect or, in rare cases, identify the occurrence of fraud, the auditor does not make legal determination of whether fraud has actually occurred. Okay, reference para A1 to A6. Okay, we will continue with the responsibility for the prevention and detection of fraud. Okay, this is an important to management. Okay, first, the primary responsibility for the prevention and detection of fraud rests with both those charged with governance of the entity and management. Second, those who monitor place a strong emphasis on fraud prevention, in which it will reduce opportunities for fraud to take place, and fraud deterrence, which encourage individuals not to commit fraud. Okay, this is also involves a commitment to creating a culture of honesty and ethical behavior, which can be reinforced by an active oversight by those charged with governance. Okay, furthermore, those charged with governance includes consider the potential for overriding of controls or other inappropriate influence over the financial reporting process, such as efforts by management to manage earnings in order to influence the perception of analysts to the entity's performance and profitability. Okay, next we'll continue with the responsibilities of the auditor. An auditor who conduct an audit accordance with ISAs is responsible to obtain reasonable assurance that financial statements taken are free from fraud and error. As being described in ISA 200, the potential effect of inherent limitations are particularly significant in the case of misstatements in the case resulting from fraud. Okay. Meanwhile, collusion may cause the auditors to believe that audit evidence is persuasive when it is in fact false. Okay. Auditors, according to the ISA, okay, auditors' ability to detect a fraud depends on factors such as the skillfulness of the perpetrator, the frequency and extent of manipulation, the degree of collusion involved, the relative size of individual amounts manipulated, and the seniority of those individuals involved. Okay, once auditor can detect the error incurred, potential opportunities for fraud to be perpetrated, it is difficult for the auditor to determine whether misstatements in judgment areas such as accounting estimates are caused by fraud or also error. Okay, to continue with the slide number 5. Furthermore, the risk of the auditor on not detecting a material misstatement resulting from fraud management, fraud is greater than for employee fraud because management is frequently in a position to directly or indirectly manipulate accounting records, present fraudulent financial information, or override control procedures designed to prevent similar frauds by other employees. Okay. When obtaining reasonable assurance, the auditor is responsible for maintaining professional skepticism throughout the auditor, considering the potential for management override of effective for detecting error may not be effective in detecting fraud. The requirements in this ISA are designed to assist the auditor in identifying and assessing the risk of material misstatement due to fraud and designing procedures to detect such misstatements. With that, I will let my friend continue with the next slide. Thank you.
Assalamualaikum, I'm Diana. I will discuss regarding the effective date and definition first. These international standards on auditing, ISA 240, the auditor's responsibility relating to fraud in an audit of financial statement is effective for audit of financial statement for period beginning on or after December 15, 2009. As for the definition, the ISA stated that the fraud definition is an intentional act by one or more individuals among management, those charged with governance, employee, or third parties involving the use of deception to obtain an unjust or illegal advantage. While the definition of fraud from Oxford English Dictionary said that it is the crime of cheating somebody to get money or goods illegally. Next definition will be the fraud risk factor, also known as the fraud triangle. The ISA stated that it is an event or condition that indicate an incentive or pressure to commit fraud or provide an opportunity to commit fraud. This slide will discuss about the objective. ISA 240 have three objectives which are identify and assess, obtain audit evidence, and respond. Identify and assess is when the auditor has to identify and assess the risk of material misstatement of the financial statement due to fraud, while as for obtain audit evidence, it is to obtain sufficient appropriate audit evidence regarding the assessed risk of material misstatement due to fraud through designing and implementing appropriate responses. Lastly is for the response, where the auditor responds appropriately to fraud or suspected fraud identified during the audit. For professional skepticism, there are three paragraphs included, which are paragraph A7 till A9. Professional skepticism is where the auditor shall maintain professional skepticism throughout the audit, recognizing the possibility that a material misstatement due to fraud could exist, notwithstanding the auditor's past experience of the honesty and integrity of the entity management and those charged with governance. It is where the paragraph A7 till A8 being used. A7 is where the auditor maintaining professional skepticism that require an ongoing questioning of whether the information and audit evidence obtained suggests that a material misstatement due to fraud may exist. It includes considering the reliability of the information to be used as audit evidence and the control over its preparation and maintenance where relevant. Due to the characteristic of fraud, the auditor professional skepticism is particularly important when considering the risk of material misstatement due to fraud. A8 is where the auditor cannot be expected to disregard past experience of the honesty and integrity of the entity management and those charged with governance. The auditor professional skepticism is particularly important in considering the risk of material misstatement due to fraud because there may have been changes in circumstances. Next, the auditor has reason to believe the contrary as the auditor may accept records and documents as genuine. If condition identified during the audit cause the auditor to believe that a document may not be authentic or that terms in a document have been modified but not disclosed to the auditor shall investigate further. This is where paragraph A9 is used. It stated that an audit performed in accordance with ISA rarely involves in the authentication of document, nor is the auditor trained as or expected to be an expert in such authentication. However, when the auditor identifies conditions that cause the auditor to believe that a document may not be authentic or that terms in a document have been modified but not disclosed to the auditor, possible procedure to investigate further may include by affirming directly with the third party and also using the work of an expert to assess the document authenticity. Lastly, if the response to inquiry of management or those charged with governance are inconsistent, the auditor shall investigate the inconsistency. This slide will discuss about the discussion among the engagement team. ISA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment require a discussion among the engagement team member and a determination by the engagement partner of which methods are to be communicated to those team members not involved in the discussion. This discussion shall place particular emphasis on how and where the entity financial statement may be susceptible to material misstatement due to fraud, including how fraud might occur. The discussion shall occur setting aside belief that the engagement team member may have that management and those charged with governments are honest and have integrity. There are two paragraphs related to the discussion among the engagement team, which are paragraph A10 and paragraph A11. Paragraph A10 stated that to discussing the susceptibility of the entity's financial statement to material misstatement due to fraud with the engagement team is by providing an opportunity for more experienced engagement team members to share their insight about how and where the financial statement might be susceptible to material misstatement due to fraud. Besides, it is also to enable the auditor to consider an appropriate response to such susceptibility and to determine which member of the engagement team will conduct certain audit procedure. Lastly, it also permits the auditor to determine how the result of audit procedure will be shared among the engagement team and how to deal with any allegation of fraud that may come to the auditor's attention. As for paragraph A11, the discussion may include such matters like an exchange of ideas among engagement team members about how and where they believe the entity financial statement may be susceptible to material misstatement due to fraud. However, management could perpetrate unconcealed fraudulent financial reporting and how assets of the entity could be misappropriated. Besides, consideration of circumstances that might be indicative of earning management and the practice that might be followed by management to manage earnings that could lead to fraudulent financial reporting, and also a consideration of the known external and internal factors affecting the entity that may create an incentive or pressure for management or others to commit fraud. Provide the opportunity for fraud to be perpetrated and indicate a culture or environment that enable management or others to rationalize committing fraud. Next, a consideration of management involvement in overseeing employees with access to cash or other assets susceptible to misappropriation. Furthermore, a consideration of any unusual or unexplained change in behavior or lifestyle of management or employee which have come to the attention of the engagement team, and an emphasis on the importance of maintaining a proper state of mind throughout the audit regarding the potential for material misstatement due to fraud. In addition, a consideration of the type of circumstances that, if encountered, might indicate the possibility of fraud. Likewise, a consideration on how an element of unpredictability will be incorporated into the nature, timing, and extent of the audit procedure to be performed, and a consideration of the audit procedure that might be selected to respond to the susceptibility of the entity financial statement to material misstatement due to fraud, and whether certain types of audit procedures are more effective than others. Moreover, a consideration of any allegation of fraud that have come to the auditor's attention. Finally, a consideration of the risk of management override of control. Lastly, I will discuss about the risk assessment procedure and related activities. When performing risk assessment procedure and related activities is to obtain an understanding of the entity and its environment, including the entity internal control as required by ISA 315. The auditor shall perform the procedure as discussed after this to obtain information for use in identifying the risk of material misstatement due to fraud. We will start with the management and others within the entity, where the use of paragraph A12 to A18 that I will discuss in next slide. It is where the auditor shall make inquiries of management regarding the management assessment of the risk that the financial statement may be material misstated due to fraud, including the nature, extent and frequency of such assessment, which related to paragraph A12 till A13. Next is the management process for identifying and responding to the risk of fraud in the entity, including any specific risk of fraud that management has identified or that have been brought to its attention. All classes of transaction, account balance or disclosure for which a risk of fraud is likely to exist, and referring to paragraph A14. Lastly is the management communication, if any, to those charged with government regarding its process for identifying and responding to the risk of fraud in the entity, and also the management communication, if any, to employee regarding its view on business practice and ethical behavior. Furthermore, the auditor shall make inquiries of management and others within the entity as appropriate to determine whether they have knowledge of any actual, suspected or alleged fraud affecting the entity, referring to paragraph A15 to A17. Finally, is for those entities that have an internal audit function, the auditor shall make inquiries of internal audit to determine whether it has knowledge of any actual, suspected or alleged fraud affecting the entity, and to obtain its view about the risk of fraud that refer to paragraph A18. In the second place will be to those charged with governments. It is stated that unless all of those charged with governments are involved in managing the entity, the auditor shall obtain an understanding of how those charged with governments exercise oversight of management processes for identifying and responding to the risk of fraud in the entity and the internal control that management has established to mitigate this risk. As referring to paragraph A19, it is for those charged with governments of an entity oversee the entity system for monitoring risk, financial control, and compliance with the law. In many countries, corporate governance practices are well developed, and those charged with governments play an active role in oversight of the entity assessment of the risk of fraud and of the relevant internal control. Since the responsibility of those charged with governance and management may vary by entity and by country, it is important that the auditor understand their respective responsibility to enable the auditor to obtain an understanding of the oversight exercised by the appropriate individual. Paragraph A20 said that an understanding of the oversight exercised by those charged with governance may provide insights regarding the susceptibility of the entity to management fraud, the adequacy of internal control over risk of fraud, and the competency and integrity of management. The auditor may obtain this understanding in a few ways, such as by attending meetings where such discussion takes place, reading the minute from such meeting, or making inquiries of those charged with governance. Paragraph 821 written that in some cases, all of those charged with governance are involved in managing the entity. This may be the case in a small entity where a single owner manages the entity and no one else has a governance role. In this case, there is ordinarily no action on the part of the auditor because there is no oversight separate from management. Next is when all of those charged with governance are involved in managing the entity, the auditor shall make inquiries of those charged with governance to determine whether they have knowledge of any actual suspected or alleged fraud affecting the entity. These inquiries are made in part to corroborate the response to the inquiries of management. In this slide, we will be discussing about paragraph A12 to A18. Paragraph A12 is where the management accepts responsibility for the entity's internal control and for the preparation of the entity financial statement. Accordingly, it is appropriate for the auditor to make inquiries of management regarding management on assessment of the risk of fraud and the control in place to prevent and detect it. The nature, extent, and frequency of management assessment of such risk and control may vary from entity to entity. In some entities, management may make detailed assessment on an annual basis or as part of continuous monitoring. In other entities, management assessment may be less structured and less frequent. The nature, extent, and frequency of management assessment are relevant to the auditor's understanding of the entity control environment. For example, the fact that the management has not assessed the risk of fraud may some circumstances be indicative of the lack of importance that management places on internal control. For paragraph A13, in some entities, particularly smaller entities, the focus of management assessment may be on the risk of employee fraud or misappropriation of assets. In the case of entities with multiple location management processes, may include different levels of monitoring or operating location or business segment. Management may also have identified operating location or business segment for which a risk of fraud may be more likely to exist, as stated in paragraph A14. Paragraph A15 written that the auditor inquiries of management may provide useful information concerning the risk of material misstatement in the financial statement resulting from employee fraud. However, such inquiries are unlikely to provide useful information regarding the risk of material misstatement in the financial statement resulting from management fraud. Making inquiries of others within the entity may provide individuals with an opportunity to convey information to the auditor that may not otherwise be communicated. Next is paragraph A16, where an example of others within the entity to whom the auditor may direct inquiries about the existence or suspicion of fraud, including the operating personnel not directly involved in the financial reporting process, employee with different level of authority, employee involved in initiative, processing, or recording complex or unusual transactions, and those who supervise or monitor such employee. Besides, it is also applicable to in-house legal counsel, chief ethics officer or equivalent person, and the person in charge with dealing with allegation of fraud. In addition, paragraph A70 said that the management is often in the best position to perpetrate fraud. Accordingly, when evaluating management response to inquiries with an attitude of professional skepticism, the auditor may judge it necessary to corroborate response to inquiries with other information. Lastly is the paragraph A18, where the ISA 315 and IXA 610, using the work of internal auditor, establish requirements and provide guidance in audits of those entities that have an internal audit function. In carrying out the requirement of those ISA in the context of fraud, the auditor may inquire about specific internal audit activities, including, for example, the procedure performed, if any, by the internal auditor during the year to detect fraud and whether management has satisfactorily responded to any finding resulting from those procedures. The third risk assessment procedure and related activities are the unusual or unexpected relationship identified. It is where the auditor shall evaluate whether unusual or unexpected relationship that have been identified in performing analytical procedures, including those related to revenue accounts, may indicate of material misstatement due to fraud. Next will be the other information. The auditor shall consider whether other information obtained by the auditor indicate risk of material misstatement due to fraud, and referring to paragraph A22. In addition to information obtained from applied analytical procedure, other information obtained about the entity and its environment may be helpful in identifying the risk of material misstatement due to fraud. The discussion among team members may provide information that is helpful in identifying such risks. In addition, information obtained from the auditor's client acceptance and retention process and experience gained on other engagement performed for the entity, for example, engagement to review interim financial information, may be relevant in the identification of the risk of material misstatement due to fraud. Finally, will be the evaluation of fraud risk factor, which include 5 paragraphs from A23 to A27. Evaluation of fraud risk factor is where the auditor shall evaluate whether the information obtained from the other risk assessment procedures and related activities performed indicate that one or more fraud risk factors are present. While fraud risk factor may not necessarily indicate the existence of fraud, they have often been present in circumstances where fraud have occurred and therefore may indicate risk of material misstatement due to fraud. Paragraph A23 is where the fact that fraud is usually concealed can make it very difficult to detect. Nevertheless, the auditor may identify events or conditions that indicate an incentive or pressure to commit fraud or provide an opportunity to commit fraud. For example, is the need to meet expectations of third parties to obtain additional equity financing may create pressure to commit fraud. The granting of significant bonus if unrealistic profit targets are met may create an incentive to commit fraud, and also a control environment that is not effective may create an opportunity to commit fraud. Fraud risk factor cannot easily be ranked in order of importance. The significance of fraud risk factor varies widely. Some of these factors will be present in entities where the specific conditions do not present risk of material misstatement. Accordingly, the determination of whether a fraud risk factor is present and whether it is to be considered in assessing the risk of material misstatement of the financial statement due to fraud requires the exercise of professional judgment, instead in paragraph A24. Paragraph A25 is when the example of fraud risk factor related to fraudulent financial reporting and misappropriation of assets. These illustrative risk factors are classified based on the three conditions that are generally present when fraud exists: when an incentive or pressure to commit fraud, a perceived opportunity to commit fraud, and an ability to rationalize the fraudulent action. The risk factor reflective of an attitude that permits rationalization of the fraudulent action may not be susceptible to observation by the auditor. Although the fraud risk, nevertheless, the auditor may become aware of the existence of such information. Although the fraud risk factor described cover a broad range of information situations that may be faced by auditor, there are only examples and other risk factors may exist. Besides, paragraph A26 stated that the size, complexity, and ownership characteristic of the entity have significant influence on the consideration of relevant fraud risk factor. For example, in the case of a large entity, there may be factors that generally constrain improper conduct by management, such as an effective oversight by those charged with government, and effective internal audit function, and the existence and enforcement of a written code of conduct. Furthermore, fraud risk factors considered at a business segment operation level may provide different insight when compared with those obtained when considered at an entity-wide level. Lastly will be the paragraph A27, where in the case of small entity, some or all these considerations may be inapplicable or less relevant. For example, a smaller entity may not have a written code of conduct, but instead may have developed a culture that emphasizes the importance of integrity and ethical behavior through oral communication and by management example. Domination of management by a single individual in small entity does not generally in and of itself indicate a failure by management to display and communicate an appropriate attitude regarding internal control and the financial reporting process. In some entities, the need for management authorization can compensate for otherwise deficient control and reduce the risk of employee fraud. However, domination of management by a single individual can be a potential deficiency in internal control since there is an opportunity for management override of control. Next slide, we continue by Nuri.
Assalamualaikum, my name is Nurin Sharina and I will present on the identification and assessment of the risk of material misstatement due to frauds. Number 1. In compliance with ISA 315, the auditor they shall define and evaluate the risk involved. That includes transactions, balances of accounts and disclosures. Number 2. When determine and evaluate the risk of material misstatements, the auditor they shall evaluate the forms of revenue transaction or claims that give rise to such risks. According to paragraph 47, that describe the documents needed if the auditor determines that the presumption is not valid in the circumstances of the undertaking and has therefore not established the identification of revenue as a possibility of material misstatement due to fraud. So referring to the paragraph A28 until A30, I can summarize that the revenue recognition includes of two, which is overstatement revenues, such as premature revenue recognition and recording fictitious revenues. For the understatement revenues, they are improperly shifting revenues to a later period. Pressures on management to commit fraudulent financial reporting through inappropriate revenue recognition. As an example, the performance is measured in terms of year-over-year revenue growth or profit and generate a substantial portion of revenues through cash sales. Presumption rebutted, which is single type of simple revenue transaction. An example is leasehold revenue from a single unit rental property. Number 4 is the auditor they shall consider certain risk assessment which is a need to gain understanding of the related controls of the company, including control activities relevant to those risks. Referring to the paragraph A31 to A32, I can summarize which is in determine which control to implement to prevent fraud. The management, they conclude that it is not cost effective to implement and maintain particular control in relation to reduction of risk to be achieved. So it's important for the auditor to obtain understanding of the control itself that the management had designed, had implemented and maintained to prevent and detect the fraud. The management also that has consciously chosen to accept the risks associated with a lack of segregation of duties. So for this slide is responses to the assessed risk of material misstatement due to fraud. As you can see from the overall responses referring to the paragraph A33 in accordance with ISA 330, the auditor they shall decide the overall response to the risk assessment of material misstatement due to fraud at the level of the financial statement. So for the paragraph A33, they include which is the increased sensitivity in the selection of the nature and extent of documentation to be examined in support of material transactions. The second point is they increase the recognition of the need to corroborate management explanations or representations concerning material matters. Next is, in order to determine the overall responses, the auditor they shall referring to the three methods. First, assign and supervise personnel that taking into account expertise and skills to carry out substantial commitment obligations. Referring to the paragraph A34 until A35, the assigning additional individuals with special skill and knowledge, such as forensic and IT experts. To the extent of supervision that reflects the competency of the engagement team's member performing the work. Number two is assess of the entity's accounting policy, in particular those relating to arbitrary metrics and complex transactions that could be indicative of deceptive financial reporting arising from management attempts to control earnings. Next is number three, which is incorporate an element unpredictability in the selection of the type, timing, and scope of audit procedures. Based on the paragraph A36, the performing substantive procedure on selected accounts balances and assertions not otherwise tested due to the materiality of risk. Second is adjusting the timing of audit procedures. Third is using different sampling method. And the fourth is performing audit procedures at different locations or unannounced basis. For the audit procedures responsive to assess risk of material misstatement due to fraud at the assertion level. According paragraph A37 to A40 in accordance with ISA 330, the auditor they shall execute further audit procedures, the type, timing and extent of which are sensitive to the risk assessment. Based on the previous slide, you can see the content of the from A37 until A40. From the A37, the nature and the timing and the extents of the procedure. For the nature, they may need to be changed to obtain audit evidence. They're more reliable and relevant using computer-assisted audit techniques. For the timing, they may need to be modified. Intentional misstatement or manipulation involve improper revenue recognition, such as auditor elect to apply substantive procedure to transaction occurred. For the extent of the procedures, they reflects the assessment of the risk. As an example, increasing sample size of or performing analytical procedures. For the A33, the risk affects inventory quantities, which is the examined entity's record that may help to identify locations or items that require specific attentions. For the A39, they include asset evaluation, specific transaction including restructurings or disposal of a segment of the business, and accrued liability such as pensions and other post-employment benefit obligations. And the last one is A40, example of possible audit procedures that include fraudulent financial reporting from revenue recognition and misappropriation of assets.
Okay, thank you Nurin for your explanation. Okay, and now I am going to dive deeper on the response to the assessed risk of material misstatement due to fraud. To be focused, it is about the audit procedure responsive risk related to management override of control. Okay, we need to auditors need to focus on the management control because management is in special position to commit fraud because the management has ability to manipulate the accounting record, and next they also have the ability to prepare fraudulent financial statement. They also in position to override control, means overuse of control in the business operation. So auditors must make sure the management not override their control in the business operation. Okay, next for the level of risk. For every entity, the level of risk of management to override the control is different. So for every entity, the auditor need to assess the level of risk of management because the way the management override the control is different in every entity, so it is unpredictable on how management override those control. Okay, and next, to cope with this problem, auditors require to design and perform audit procedure in order to test appropriateness of journal entries and other adjustment, to review the accounting estimate for bias and evaluate whether the circumstances producing the bias, and lastly, to investigate the significant transaction outside normal course of business. Okay, in this slide, I am going to further dive deeper on the audit procedure that I have mentioned before. The first one is to test the appropriateness of journal entries and other adjustment. Okay, the auditors need inquiry the individual involved if financial reporting process about unusual activity or transaction that occur in the journal entries and other adjustment. And next, the auditor need to select the entries and other adjustment made at the year end and consider the need to test those journal entries and other adjustment throughout the period. Okay, let's now see the reference, which is the paragraph A41 and till paragraph A44. Based on the paragraph A41 and A44, it is mentioned that material misstatement of financial statement due to fraud often involve the manipulation of financial reporting by recording unauthorized journal entry. This unauthorized journal entry may occur throughout the years or at the year end of the financial reporting. The indication that might lead to this unauthorized journal entry is by the adjustment or reclassification of account made by the management. Okay, further, the auditor's consideration of risk of material misstatement associated with inappropriate override of control over journal entries is important because the automated process and control can reduce the risk of inadvertent error, but it does not settle down the risk that individual may inappropriately override such automated process. Okay, I give you an example. In the example that I can give is the management might change the amount being automatically passed in the general ledger or to the financial reporting system. Since IT were used to transfer information automatically, there is no visible evidence of such intervention in the information system. Okay, this is the consideration that the auditors need to take note when identifying the selected journal entries and other adjustment for testing. Okay, the first consideration is the auditors must focus on the assessment of the risk of material misstatement due to fraud. Okay, the second one is control that have been implemented over journal entries and other adjustment. The third consideration is the entity financial reporting process and the nature of evidence that can be obtained. The next consideration is the characteristic of fraudulent journal entries or other adjustment, the nature and complexity of account, and lastly, journal entries and other adjustment processed outside the normal course of business. However, fraudulent journal entry and other adjustment are often made at the year end of the reporting period. So, the auditors need to select the journal entries and other adjustment made at the time. Okay, to further dive deeper on that, material misstatement in financial statement due to fraud can also occur throughout the period. And if this happen, the auditors need an extensive effort to conceal how the fraud is accomplished. So based on paragraph 32A3, it is required the auditor to consider the need to test journal entries and other adjustment throughout the period. If the auditors need to test this throughout the period, and it's become more burdenful to the auditors, but in order to further to collect the information about the fraud, the auditors must do this. Okay, and now let's move on to the second audit procedure. The auditors need to review the accounting estimate for biases and evaluate the circumstances for bias. Auditors need to evaluate whether the decision of accounting estimate by management are included in the financial statement. And next, auditors need to point out any possible bias on entity management that could lead to risk of material misstatement due to fraud. Okay, the auditors need to perform retrospectively on review of management judgment and assumption related to accounting estimate that reflected in financial statement in prior year. Okay, let us dive deeper on what the paragraph A45 to paragraph A47 said. Okay, as per paragraph A45 to A47, okay, it is said that the preparation of the financial statement require management to make judgment and assumption that affect the significant accounting estimate, and next, to monitor the reasonableness of the estimate that were made ongoing basis. Okay, fraudulent financial reporting is accomplished through the intentional misstatement of accounting estimate. Example, the management can overstating all provision or reserve in the same fashion in order to design a smooth earning over 2 or more accounting period. And next, to designate earning level in order to deceive financial statement. In order to maintain the perception as to entities' performance and profitability. Okay, in order, let's say example, in order to show that the company has significant improved year by years, okay, the management fraudulently overstating all the provision made and reserve. So when the management did that, we can see the trend that maybe the net profit after tax is become increasing year by year. So it can show that to the stakeholders that the company is performing very well, or even though it is actually not performing at all. The purpose of performing retrospective review of management judgment is related to significant accounting estimate that reflect to the financial statement of prior year to determine whether there is indication of possible bias on the part of management. Okay. In this slide, I am going to explain the third procedure, which is the investigate significant transaction outside normal course of business. Auditors shall evaluate whether the business rationale of those transactions lead to management had engaged in fraudulent financial reporting and concealed management of asset. Okay, let's dive deeper on the paragraph A48. Okay, in paragraph A48, indicator that may suggest that significant transaction that outside normal course of business or transaction that appear to be unusual might be the engagement in fraudulent financial reporting. Okay, those those engagement might include the following points. Okay, the first point is the transaction appear to be overly complex. As example, transaction involve multiple entities within consolidated group or multiple unrelated third parties. So if the company is consolidation, the transaction are linked to each other. Maybe the subsidiaries buy from the holding and then the holding sell back to the other subsidiaries. So that's what the point one means. Okay, the point two is management has not discussed the nature and accounting for such transaction with those charged with governance of the entities and inadequate documentation. So the transaction, the management does not further explain about the nature and accounting for those transactions, and there are also not enough documentation for those transactions. Okay, the transaction are also involve non-consolidated third parties, including special purpose entity. And lastly, the transaction involve previously unidentified related parties or parties that do not have the ability or financial strength to support the transaction without the assistance of the entity that were audited by the auditors. In this slide, I am going to further explain on the evaluation of audit evidence. The auditors need to evaluate the analytical procedure performed and next need to form an overall conclusion. Auditors must ensure that their understanding are consistent with the financial statement of the entity. Apart from that, auditors must point out previously unrecognized risks of material misstatement due to fraud. Okay, let's see the paragraph A50. In paragraph A50, professional judgment is required when determining the trend and relationship that indicate a risk of material misstatement due to fraud. Okay, as example, uncharacteristically large amount of income being reported in last few weeks might also be the indicator of fraud. Or there is unusual transaction, or the income that gained by the company are not consistent with the trend that are determined by the auditors. So if there is an income that are not following the trend, so it might be in the indicator of the fraudulent activity. If misstatement is identified, auditors need to evaluate whether the misstatement is an indicator of fraud or not. If there is indicator of fraud, auditors need to evaluate the effect of the misstatement in relation to other area of audit. The reliability of management representation need to be assessed. Okay, let's refer to paragraph A51. Since the fraud involves incentives or pressure or opportunity or rationalization, it is instance of fraud is unlikely to be an isolated occurrence. Okay, numerous misstatement at specific location, even though it is not material, can be indicator of a risk of material misstatement. If misstatement identified, auditor has reason to believe that it can be consequences of fraud and management is involved. Auditors need to re-evaluate the assessment of risk of material misstatement due to fraud and its impact on the nature, timing and extent of the audit procedure. Auditors also need to consider that there is a possible collusion involving employee, management and third parties when assessing the reliability of obtained evidence. Okay, let's see the paragraph A52. In paragraph A52, it is stated that the implication of identified fraud depend on the circumstances. As example, insignificant fraud may be significant if it is involved the senior management. If the senior management involved, it can be significant. The fraud can be significant. The reliability of evidence previously obtained can be questionable. It create a doubt about the completeness and truthfulness of representation made about the genuineness of account record and the documentation. There also might be possibilities of collusion involving employees, management, or third parties.
So now we will explain about the theory of fraud triangle. So there are three elements of fraud triangle. Number one is pressure, number two is rationalization, number three is opportunity. So in terms of pressure, it's actually a financial or emotional force pushing towards committing fraud. For rationalization, it's a personal justification of dishonest actions. And for the opportunity, it's actually the ability to execute plan without being caught to commit the fraud. Number one is in terms of incentive or pressure. Okay, incentive or pressure is said as financially or emotionally factors which force someone to commit fraud. Okay, this pressure can come from internal pressure and external pressure. So for internal pressure, as for example, maybe from the staff or employee itself. Okay, for example, like if the employee are handling a big amount of petty cash money, so just because of the staff has a personal problem which relate to money, so there is a tendency that push the staff to commit the fraud, okay, by taking the money, okay. And then for the external pressure, okay, maybe it can be from the organization itself or the industry that the organization are in, okay. And then financial stability is actually affected by few factors. Okay, first is market saturation. Number two is vulnerability to rapid changes, and number three is significant decline in customer demand. So for the organization, sometimes it's a pressure for the organization to commit the fraud. Okay, sometimes it's because of this economic or financial stability that I just mentioned here. Next, excessive pressure from the third party to management are due to first, okay, to achieve profitability or to meet reasonable expectation of investment analysts, institutional investor. Okay, particularly all these expectations are unrealistic. Okay, including expectation created by the management, as for example, overly press release on the performance of the company or annual report. Okay, number two is to obtain additional debt or to increase the equity to stay competitive. So sometimes the company misstatement, commit the fraud, okay, in the financial report, which arising in the misstatement of in the financial report, okay, is due to attract more investor, okay, to invest in the company in order to stay competitive in the market. Okay, so definitely this is a wrongdoing. Okay, number three is to create marginal ability for debt repayment. Okay, and why is actually management or personnel commit fraud? Okay, first is because maybe they have a significant financial interest in the entity. Okay, number two, maybe because they have been promised of the compensation or benefit, okay, by the entity. For example, like, okay, if you can make can increase the revenue in from your department 10% this year, then maybe you can get 30% discount bonus for this year, let's say like that. Okay, so this will push, okay, the management of the department or personnel, okay, to do commit fraud in order to do the misstatement in the financial reporting. Okay, number 3 is personal guarantee of debt. Okay, number 2 is opportunities. Opportunities is said as circumstances that allow the fraud to happen. Okay, so there are three factors that affect the fraud which arising from the opportunities are: first, ineffective monetary management. Okay, the domination of management by a single person or small group that has interest in the company's management decision. Okay, and then second is it's controlled by those charged with governance. Okay, and third one is internal control is not effective. The internal control is created, but it's not effective, okay, to reduce the risk of fraud in the organization. Okay, next is complex organizational structure. So actually a complex organizational structure makes it difficult in determining the in organizational or individual that have interest in the entity. Okay, an organizational structure involving unusual entity. And number 3 is high turnover of senior management. So usually the senior management knows the history or of the management or the organization. So with the high turnover of the senior management, which they always come in and come out. So this indirectly will affect, okay, the decision or the management itself in the organization. And number 3 is lack of internal control. Okay, lack of internal control can cause, okay, can create a loophole for the fraud to happen. Okay, high turnover rate of employment, and also accounting and information system that are not effective. Okay, uh, for a lack of monitoring control, okay, maybe the person or the person who in charge to monitor, okay, the the job, okay, of the staff, okay, maybe fails, okay, to monitor their job. So this is why uh, the opportunities are there for the staff to commit the fraud. For example, like uh, uh, the for example, like the uh, account for example, like the uh, um for example, like if the person do the payable parts or the receivable part, okay, they will do their job, but nobody monitor their job. Are they did their job properly or not? So this is the issue. The nature of the industry or entities operation provide opportunities to engage in fraudulent financial reporting that can arise from the following. Okay, first is significant related party transaction not in the ordinary course of business or with related entities not audited or audited by another firm. I mean to say it, the company financial account is audited by the same firm, so there is a issue. Okay, and number two is a strong financial presence or ability to dominate a certain industry or sector that allows the entity to dictate terms or conditions to supplier or customers that may result in an inappropriate or non-arm's length transaction. Okay, number three is uh, all assets, liability, and revenue or expenses is based on a significant estimation that involves subjective judgment or uncertainties that are difficult to corroborate. Okay. Um, Number four is to exercise tax haven jurisdiction. Okay, so significant bank accounts or subsidiary or branch operation in tax haven jurisdiction for which there appears to be no clear business justification. Next is in terms of attitudes or rationalization. Okay, there are few factors arising from rationalization in committing fraud. Okay, number one is ineffective enforcement of good values and ethical standard by management. So the management in the organization does not emphasize on the good practice value among the staff. Okay, for example, like to be transparent when you report. Okay, and to be truthful and to be responsible and avoid the fraud or misstatement. Okay, number two is uh, involvement of senior management who known for security violation. Okay, this means that, okay, for example, like a junior staff who is under supervision by the senior who known charge for governance. Okay, they don't have the power to say no to not committing the fraud. Okay. Number three is interest by management to increase or maintain the stock price. Okay, in order to meet the management objective, okay, to maintain the stock price, okay, uh, uh, okay, so the staff will do will okay act on not transparent, okay, by reporting misstatement or committing fraud, okay, in order to get a staff benefit in return, for example, like bonus of the year and so on. Okay, number four is minimize reported earning for tax motivation. Okay, by minimizing the revenue in the financial report, okay, this can reduce the tax entitlement. So this can be said as to serve the favor of the top management, although it involves misstatement, okay, fraud. Okay, now the relationship between the auditor and the management. Okay, there are a few unfavorable relationship between the management and auditor. Okay, first is frequently dispute between management and auditor. Okay, sometimes the issue raised on the accounting recognition. Okay, because sometimes the management might have their personal interest. Okay, why they recognize this way and that way. But as for the auditor, okay, they have to follow the standard, and so these differences might create issue between them. Second is unreasonable demands on the auditor, for example, like request the auditor for unqualified audited report although they are not entitled for that. Okay, number three is limited the auditor for information. So they put a limitation for the auditor to access the inventory or to access to the staff, okay, for inquiry. Okay, and number four is unfavorable management behavior. Okay, by bullying the auditor or being disrespectful with the auditor when they do the field work. Okay, now we will talking about risk factor arising from misstatement, arising from misappropriate use of asset. Okay, it seems we have three. Okay, also those three elements also: incentive or pressure, opportunities, and attitude or rationalization. So for incentive, okay, adverse relationship between the entity and employee will pressure the employee to misappropriate the asset. For example, like pressure the staff, okay, to recognize the asset as their favor, okay, or else they will be laid off. Okay, second is change to employees compensation. Okay, and for opportunities, okay, certain circumstances that provide the management or employee to commit misappropriation of asset. Okay, first, for example, like holding large amount of cash. Okay, they have the opportunity, okay, to take the cash. Okay, second, handling item that is small but high in value and really high demand in the market. Okay, this is caused by lack of internal control, and those actions are caused by lack of internal control. Okay, for example, like lack of duty segregation. Okay, and second is lack of oversight by senior management. Second is second example is lack of oversight senior management expenditure. Number three is attitude or rationalization. Okay, this arises due to disregard for the need of monitoring to reduce the risk. Okay, they take the monitoring of the internal control for granted. Number two, disregard for the internal control over handling of asset. Number three is behavior indicating displeasure. Number four, changes in behavior or lifestyle. And number five is tolerance of petty cash theft.